All right, so as we're looking at these 100 days for the president, obviously we all know what the stock performance is. We've seen the markets under quite a bit of pressure. A lot of that's due to tariffs. What do you see as the outlook for the rest of this term?
Yeah, well, I'd say the one good thing you'd look at is this bounce back that we've seen is a little bit more of a broadening out, in the markets. And so if you look into the second half of the year, hopefully we start to get a little more certainty on tariffs. You've seen whether it's some concessions on autos or other things, hopefully some deals come through, and you can hopefully move kind of beyond the tariff policy into tax deregulation, some of the things we had hoped to see kind of coming into the year. But I do think it has, you positioned a bit more defensively in the current market and then looking out into the rest of the year before you start leaning into more cyclicals.
Okay. What do you think about the defensive trade? Today, we have a number of consumer-focused stocks. One of them is Kraft Heinz, a defensive name. Just last week, they had a pretty rough week. What's your view on that so-called defensive trade?
Yeah, I mean, a lot of it has, played out, and I think some trimming, was needed after you've seen kind of that, big bounce, but it is a safe place to be. I mean, we would focus on diversification, across the portfolio, but if you look at some of the good secular trends around, power and energy and utilities, there still seem to be places that you can find some, safe harbor, during this period.
Another area a lot of people are looking at is the consumer. Stocks that have direct exposure to the consumer. Obviously, some of the big tech names have been under pressure. They've been trading lower because there's growth concerns. But today we get a number of companies. Starbucks is one. Direct exposure to the consumer. UPS, a big part of their business is consumer focused. How are you viewing those names?
Yeah, well, I think it's going to be tough because Q1 still is probably going to look pretty solid. So it's looking into where the forecasts are and the expectations going in through the rest of the year. But if you look at consumer, with their spending, still seems to be pretty solid. Labor hasn't kind of pulled off yet, and so it's going to be important to see if we get actually some guidance.
Another area you like is international stocks, specifically Europe. So we're going to show right now how the S&P and the Stock 600 are performing since the inauguration. Obviously, kind of a change in trade policy and a lot of other changes since then. I'm looking at the Stocks 600 up fractionally right now. The S&P down over 7.5%. I do want to ask, would you still put money into Europe, even though we don't have a trade deal yet? And there's potential for more just trade uncertainty, trade tensions between the U.S. and Europe. And I would think that Europe would be more negatively impacted. Yeah,
no, it's totally fair. But I think you could also say that there's been overallocation to the U.S. For various reasons for the past decade, and we've seen some money flow already into Europe. So some of that trade has already started. But you've got maybe easing is a little bit more kind of expected, and known. You get some fiscal spending coming out of Germany, and we've seen it through the defensive, as you might see some infrastructure, and other spending start to help, Europe, and it's still from a valuation perspective, under the U.S. And so, again, a theme of diversification, outside of the U.S., and we think that, Europe, even if you start to see, some, slowdown, persist, that it's still a good place to be allocating.